Whoa, is that the sound of cracking ice that I hear? I don't know. This market's starting to get a little bit shaky for me. But hey, let's get right into it. This is not shaky. This is so fantastically solid. You could walk on this in the middle of winter. In the middle of summer, you could walk on it. You wouldn't break through this ice. Let's get right into this market, shall we? All right. Check this out. First of all, one of the things that's been making me very bullish for quite some time is the massive increase in the purple predictor. You'll notice that it's been rallying much stronger than the S&P 500, which means that it's been supportive of the market. That's bullish. But now it's right on top of the price action, so it's really more neutral than it has been in the recent past. Today's price action, pretty good. It is Tuesday, not Monday, as we usually are. So we're starting to see a little bit of good price action here. But I wanted to show you this chart right here. Now, over in the upper right-hand corner, we see the green line, which is bullish pressure, and we see the red line, which is bearish pressure. And of course, we had a huge difference between them for a very long time, where the green line was way above the red line, and you can see that was very bullish for the market. But then all of a sudden, the green line, the buying pressure started to fade. And then just in the last week, we started to see the selling pressure pop up. They're now equal. You got it? Equal. No longer do we have strong bullish pressure. On the other hand, we don't have bearish pressure either. The Nasdaq, you can see that once again, the purple predictor had been extremely bullish. Now, back to neutral. Still, I like being in the Nasdaq more than the other two indices. Now, seasonality. We're going to drop this down from bullish to neutral. As you can see, we've been basically in a mini bear trend since the beginning of October. But more importantly, we broke through the lows that we made in late October, and we did that just in this last week. So this means that I'm no longer going to be overweight in the market. I'm no longer going to be loading up the boat. So after that monster rally that we had, where we had double-sized positions on everything, we were just crushing the market. Nobody's going to come close to our performance at all. I'm now pulling in my horns a little bit and going to neutral, which means that I'm putting on normal size positions, not big size, not small size, normal size positions, okay? Now, if we can get a breakout up above about 151-ish, I'll switch it back to bullish. Seasonality, we've been through all this. You know very well, we're in a very, very seasonally strong period. We have Thanksgiving coming up next week, one of the most bullish patterns. That week is up 50 out of the last 64 weeks. So very strong seasonal up move. So even though I'm kind of talking about how the underpinnings of the market have been kind of jolted a little bit, they haven't broken down yet. They're just weaker than they were before. They're not doing as well. So they're kind of shaky, but not bearish. Get the difference? Okay. Now the yield curve is one of the more bullish features. You go back to last November, you can see it skyrocketing. That's helping us out this year. This is a leading indicator of the market by 1 full year. So you look at what happened a year ago to see what should be happening now. Asset allocation, which had been crumbling, actually came back. And what this means is we're seeing money flow out of the bond market pretty aggressively. We'll get to bonds later, and it's moving into the stock market. Well, that can create a tremendous amount of buying pressure. Our market riskdicator, though, now this one is getting crush-orama. Look at that thing. It had been kind of choppy, sloppy, sideways for 3 or 4 weeks. All of a sudden, it broke to new lows. What does that mean? It means that market participants don't want to be in aggressive sectors. They want to hunker down in boring sectors. So we're starting to see things like consumer staples, and we're starting to see things like utilities start to perk up. And that's where people go for a safe haven in the stock market. Because remember, mutual funds can't really go to cash. So instead, they go to low-risk stocks, and that's exactly what they're doing right now. Let's take a look at global shares. They broke to a new low. Now, the U.S. market hasn't done this yet. So as I've been saying for, a month or more, we need to be focused on the U.S. market, not on the global markets, because the U.S. is where the action is right now. Bonds. Now, I mentioned before about how the bond market the asset allocation, money had flowed out of the bond market. Well, it got up to kind of where I said it would go to last week, and then completely crapped out. Look at that big gap down. So the money they just said, that's it, we give up, we're going into stocks. We're getting out of bonds, we're getting into stocks. Now the purple predictor is still bullish here in the bond market, so I have to say, I don't want to get too aggressive on the short side. I think the best way to play the bond market is to not play the bond market. Go do something else that's more fun and more profitable. Bond key factors, the green line is the yield and it's going up. The main thing that's been affecting the bond market for the last several years has been the blue line, which is the German 10-year Treasury yield, and it's not going up, it's going sideways. That would suggest that bond yields could go down or bond prices go up. So we need to keep a close eye on this. In other words, it's really not going anywhere. The dollar is in the midst of this bull move that I talked about. We talked about the breakout of the head and shoulders bottom. This still has quite a ways to go on the upside, several percent higher, maybe up around 97, and we're not right now in the low 94 area. So about a 3 or 4% rally still in the cards here for the dollar. Now, if the dollar is strong, that should weigh on gold. But let's go back and take a look. Bull market, sideways market. That means that gold is actually holding up quite well. And when you have a market go sideways in the face of bearish news, that's actually bullish. Because what it's saying is that if the dollar were to ever stabilize or go down, gold would skyrocket up. So I'm not long gold right now, don't want to be aggressive in gold right now, but it may be setting up a very interesting trade. Now, our indicators also interesting. Up at the top, this is the euro, kind of drifting lower, kind of neutrally. Then the middle is the CRB. It's clearly bullish for gold. More importantly, it looks like our green indicator down at the bottom, that is the yen. It looks like it's forming a bottom there. Now, it's a little bit early to tell. I might be getting a little too anxious, but nonetheless, looks pretty good here. And that could be why we're seeing gold kind of be sideways right now. And then oil, we talked about putting it, that I was taking a more bullish approach to this. It's certainly been much more bullish, but quite frankly, I just can't, I'm sorry, maybe it's in my genes by now, but I cannot see oil mounting, getting to $60. So I'm just going to pass on it right now. I don't like it. I think it's overvalued, but hey, what do I know, right? All right, thanks very much, freebies. Listen, you've really, since the market is showing some cracks here, you really need to be a subscriber to the fully paid up members, because that's where you get all the recommendations on exactly how to make money in these markets. All right, fully paid up members, just hang in there for just a second, and guess what? We will get right to you.